Is it the perfect time to buy NEP? It currently offers a forward yield of over 14% right at its 52-week low. In today's episode, we're going to run through the historical performance of NEP, why it is down 66% year to date. We're going to look at the company's financial statements, their top line revenue, as well as their bottom line net income growth. We're going to take a deep dive into their balance sheet, looking at the health, their total cash versus their total debt. We want to find out how they're performing against other companies in the renewable electricity sector on a 5-year total return basis. And we also want to see what are the institutions doing. Are they buying NEP or are they selling? And as always, we will take a look at their financial metrics, understanding their dividend safety and some key dividend metrics supporting this. Now, we'll also take a look at their earnings, which they did report not too long ago. And don't forget, as always, that we do on the channel, we will put it through our stock valuation model, getting to our intrinsic value and finding our acceptable buy price given that investor margin of safety. Now, analyzing this company over the last 10 years, what we can see is that its current price is at the lowest it has been over this 10-year period. And we can see there are moments in 2015 as well as 2016 where it did hit this low price. But other than that, it did hit its 52-week high as well as its all-time high not too long ago, sitting around $86 with its all-time and 52-week high around $81. So let's take a look at the company and see whether or not this is one we can expect to grow 4, 5, 6 times as much as it is in today, and see that yield on cost growing to 20, 30%. Now, in terms of their financial statements, their top line revenue, what we'd like to see, 3 to 7% growth year on year, $771 million in December 2018, $1.2 billion in December 22. So it is positive to see that growth over the last 5 years. In fact, we can see around 50% on that top line. And on top of that, we do see what we always like, that consistent year-on-year increase. Remember, we will look at the last 10 years percentage-wise too. And we can see the trailing 12 months also looking like they will beat their top line from December 2022. Now, when we take a look at their bottom line net income, $192 million reported in 2018, $477 in 2022. Nice to see the growth as well on the bottom line, not just the top line, more than double. In fact, although when we take a look at a granular level, we do see 2019 and 2020 with a net loss before rebounding and going up even nicer in 2022. So some inconsistencies with the financial statement, in particular the income statement, but overall it is looking positive with their growing revenues. Now, total cash versus total debt, $147 million in December 2018, $332 million in their latest report. So we can see their cash position has in fact more than doubled. And when we compare that numerically and directionally to their total debt, what we can see, in fact, their long-term debt has gone from around $2.8 billion to just over $5 billion in their latest quarter. So they have increased their cash, but they have also increased that long-term debt. Now, in terms of how they perform versus some of their competitors in the industry, we have companies that you may have heard of, Atlantica Substantial, Renew Energy Global, and a few others. Now, when we take a look year to date, including those dividends reinvested, NEP is still down 63%, the worst performing in the industry. And remember, we always want to take a wider look at the time horizon. So over the last 5 years, what we see is that it is still down 31%. Again, one of the worst performing in the industries. But as a whole, the whole industry has found it hard to have positive total returns over the last 5 years. Now remember, past performance is never an indicator for the future. So in terms of institutional ownership, it's sitting at around 81%. Now 744 million worth of shares have been sold by the institutions over the last 12 months, but a bit more, around 1.1 billion, in fact, a fairly substantial amount more, have been bought by these institutions. So they are buying more shares of NEP than they are selling. But if we are to look at quarter 3, we can see there have been more outflows than inflows. However, over the last 3 quarters, the opposite holds true. Now, remember as well, as part of our analysis, we should never copy what institutions do, never follow them blindly, never buy if they buy or sell if they sell. It can just be one part of the essential investment analysis. Now, before we look at the financial metrics, we can just jump into their earnings from their September 23 call. Now, they did have a positive surprise of 29% on the EPS, beating 44 cents expectation by Wall Street at 57. However, we do see the top line drop dramatically, around 9%. It was a miss, which wasn't favored by Wall Street. Part of the reason why we see that big stock price drop. Now, if we do compare September 23's quarter versus the same quarter, September 2022, positive signs. Revenue has increased 21.5%. However, net income and the diluted earnings per share has fallen, as well as that bottom line net profit margin. So a mixed bag. Whilst we do see the top line increase, all the other metrics unfortunately have dropped. And when we take a look at just a few factors about NextEra Energy Partners, what we can see from their memo from the end of September is that they have dropped their expectations to 5 to 8% per year, at least through to 2026, with a target of 6% growth, and they also expect no growth equity until 2027. Now, a few reasons what we can have a look at why they dropped. They are a company that does increase their dividends quite consistently in double digits, so they did also reduce their dividend growth outlook from 12 to 15% to 5 to 8% per year, which I personally wouldn't say is the worst drop. That is still above that 4% inflation that I do always advocate you should aim for. We also saw at that point in time that analysts, we can see Wells Fargo in particular, did lower their price target quite substantially from 80% to $80 to $33. So there is a lot of information there as well if you do want to jump into understanding this movement. Now, in terms of the dividend safety, well, it is 42, borderline safe. It does have that very high yield of 14.23%. And we can see the market cap sitting at 2.28 billion, making it a mid-cap company. Now, in terms of some key metrics for those that believe a recession is due soon, unfortunately, they didn't pay a dividend in 07-09, so we don't have any comparative data. Now, dividend growth, this is what I was mentioning earlier. Last full year, 15% double-digit growth. Last 5 years, 15%. Again, very positive to see. But again, do note they have dropped that target to around 5 to 8%, which I personally don't see as a bad target. 8 years paying dividends consecutively, which is always positive to see. And in terms of the dividend yield theory, a company is undervalued, remember, when that current yield sits above the 5-year average. So we have our first sign of undervaluation, remembering though we don't look at any of these models in isolation. Another sign, the forward P to DCF ratio 5.7 versus the 18.1 5-year average, another sign of undervaluation. And we can see it is lower than the utilities P DCF ratio of 9.2. Now, as always, it is important to note that just because a company is at its 52-week low or near, it doesn't mean it's undervalued and it is not a buy signal. So typically, we do like to look at the free cash flow metrics, but remember, for companies, for example, if they're a REIT, we tend to ignore it, or if they're a utility company, or if they're MLPs, they are more volatile. And as we can see here, if we were to focus on this, it wouldn't be the most appropriate, as we can see, they do rely heavily on capital markets to finance their growth. So we do focus on the DCF, which is essentially their distributable cash flow, very similar to free cash flow. Now, what we do look for below 90%, very positive to see. It has been well below 90% over the last 10 years. Over the next 12 months, it is, however, expected to climb, but it is still below that 90%. So I would expect to see, as they did mention in their memo, between 6 to 8%, or 5, in fact, to 8% over the next few years. Now, in terms of the DCF per share, what we like to see is consistent increases year on year. Now, it hasn't been the most consistent from 2015, 553 to 747, but we can see it is moving in the right direction if you have been holding this company for a long time. Again, if you've only held this company from 2015 to 2019, this may not have been the most best purchase of your time. Now, in terms of sales growth, again, 3 to 7% is what we like, but some people will sit there and argue the cyclicality of these industries. So overall, it has looked very positive. It did have a very nice growth spurt from 2013 to 2016 before cooling down quite substantially. But still, other than that 2018 period, it has been around that 3 to 7% that we do like to target as a bare minimum. Numerically, for those that want to see the numbers, 180 million in 2013, 1.21 billion in 2022. So again, it has been increasing over the long haul. And shares outstanding, it is important to note that MLPs, they do retain little of that cash due to their costly growth projects and high payout ratios. So it is common that we do see share issuances diluting your position as a shareholder. So just note that that is part and parcel of the industry. 18.7 million in 2014, 84.9 in 2022. Now, ROIC, again, for MLPs, for REITs, we do look for 3 to 5%. It is a bit of a worry when it was very positive from 2013 to 2017, but it has since then come off and we are looking around 1%. Now, even the trailing 12 months is sitting at 1%, so this is a slight worry. I would like this to pick up, but you have to factor in a lot of different things when you are looking at this company, especially because it has fallen very, very sharply, and you need to see whether or not you believe this to be a value play. Because let's be honest, if that ROIC figure was sitting at 20% consistently, the share price would be a lot higher, unless there were other fundamental issues. Operating margin, what we can see, again, positive metrics up until around 2018, 2020, and then it has started to fall off, 13% in 2022. Trading 12 months, again at 10%, so this is going in the wrong direction. You do want to see consistency as an investor or an increasing margin metric. So again, it is something just to bear in mind. It doesn't mean you shouldn't invest in it, but these are all points just to consider during your investment thesis. Now, net debt to earnings before interest, tax, depreciation, amortization. Remember, these are the number of years it would take the company to pay off all of their debt net of cash on hand. And it does also correlate to that dividend safety. Now, the maximum we do look for is 4.5. But what we can see over the last 10 years, and in fact in more recent times, it has been below that, with 22 at 3.07. 23 expected to be around 3. So that does give me faith so far that that dividend will still be paid, and we see that yield for now, unless there are any other issues that come to the fray, that this dividend is safe. So we've taken a look at the metrics. Now let's jump into the valuation model. As always, if you enjoy the content, value is being provided. Hit that like button, hit the subscribe and bell to be continually notified of these videos. And if you want to grab a copy to get to the intrinsic value of companies in your own portfolio, or if you want to run through NEP on your own basis, then do click on that pinned comment below. So let's jump straight into Graham's valuation. We have the stock ticker symbol NEP. We have the earnings per share, growth rate per analyst estimates with that current yield on AAA corporate bonds. Remembering the higher the yield, the lower the intrinsic value. So we get an intrinsic value of $34. Now, when we take a look, we can see that is within the 52-week range, showing signs of undervaluation in the current market, and it is above that market value of $24. Remember, though, we don't look at any of these models in isolation, and we will draw our conclusions towards the end of the episode. We then have the multiples valuation model, companies in a similar sector and size that we analyze on the 5-year total return. Ideally, we like to add 3 or 4 in this model, but given the other companies we did analyze had negative earnings per share, it wouldn't have been appropriate. So we have Atlantica Sustainable, Enlight Renewable with their stock price, earnings per share, PE multiple. We get the average, multiply that by the earnings per share of NEP to get a multiples valuation of $68. Now, when we take a look at that, that is still within the 52-week range, but does show some very, very nice upside to the current trading price. We then move on to the third model, which is the dividend discount model. Now, very positive to see. What we can see here is the average growth rate as we ran was around 15% over the last 5 years. This is the latest dividend increase. Now, they did say they are targeting between 5 to 8%. I have gone a lot more conservative. There are people who will say you should go much higher, especially based on management guidance. But I'm going to go a little bit more conservative. And for those who do want to change the percentages, grab a copy and you can run your own figures. This gives a DDM price of $65, still showing nice upside to the current trading price and within that 52-week range, showing signs once again of severe undervaluation. Now, typically the fourth and final model would be the DCF model, but given it is a utilities or an energy company, in fact, these are a lot more volatile, as we did mention earlier. So the intrinsic value is the average of those 3 models that we have just run through. And again, if you're enjoying the content, value is being provided, do hit that like button, do subscribe and hit the bell to be continually notified of these videos. So we have an intrinsic value of $55.44, current price sitting at $24.38. Now, before we run our numbers to get to our margin of safety and our acceptable buy, Wall Street do believe the share price to go up to around $40 over the next 12 months. So they do see a lot of upside to the current trading price, as we can see here. Now, margin of safety, we always start with 10% if we believe it has a wide moat, strong financial metrics, good forward-looking data. Now, again, with NEP and with what we just discussed, there are a lot of risks just to be considered, not only with them dropping a lot of their different factors and their forward guidance, but also when we did look at their metrics, their net debt to EBITDA, their margins, their ROIC, I would be looking for a much significant margin of safety. Now, those looking at 20%, it would be a buy up to 43. Those looking at 30, still a buy. 40% margin of safety, still a buy. Now, those looking at 50%, it would still be a buy, showing it is significantly undervalued based on our estimates and judgments. At a 55% margin, you would be looking at the current trading price. So what we're trying to say with this model is that if you were to lock in a price at around the current market value, you would be getting around a 55% margin of safety. Alongside that, Wall Street are forecasting this to go right up to $40 over the next 12 months. But remember, as always, we don't copy anything that we see. We always need to do our own due diligence. As always, if you enjoyed the episode, do hit that like button, do subscribe and hit the bell. If you want to grab a copy of the valuation model to get your own intrinsic value and acceptable buy price of companies in your own portfolio, do click on that pinned comment below. And finally, just drop your comments below. I'm interested here. Do you think that there is a massive opportunity now to capitalize on NEP where you do get some significant dividend yield? Or are you staying away because you do worry the share price will drop further? And in fact, this was one of the lowest prices seen over the last 10 years. As always, have a great day, catch you on the next episode, and take care.